Hey Bear Bull traders, my name is Artie. I'm one of the moderators at our community in the chat room, usually on Tuesday and Thursday, and I talk about options. Today we're at our Vancouver office. This might seem familiar because we've recorded a lot of videos. We just got this brand new screen, and I thought it's a perfect start for our new segment in Bear Bull Traders, weekly option trades. So during these segments, I'm going to talk about market as a whole, what I'm seeing in the market. We'll discuss some macro events, and I'll talk about some of the trades going into the week. So definitely it's a new segment. If you have any ideas, any feedback, let me know in the comment section. I'm going to read them and readjust as we move accordingly. Wow. What a crazy week. Definitely it was a very volatile week with the Ukraine and Russia invasion that was going on. So overall, sectors didn't do much. So when you look at a weekly performance, I am, by the way, in our trading terminal, a tool that we developed for our traders. You can see that majority of indices didn't really do much. So just around 29 basis point IWM closed, SPY about 34 basis point, which is down but by not a lot. And then Dow was kind of the lagger of them all for the week. And then when you look at the monthly performance, because we're just finishing up February, you're seeing the same picture. So IWM is the only sector that is quite positive, but every other sector is just solely slightly above green. And then year to date, of course, all the major indexes are in red territory. But in terms of what we're seeing in the market, I think as a trader, you should still be really, really cautious. And that's for two reasons. So let me bring this up. And the reasons are right here. The volatility index, kind of your 30-day implied volatility wicks, which is at 27.28. Basically what this means is about a 28% standard deviation for a SPY for the year, which is really, really high. Historically, it's only about 17 to 18. So anytime VIX is above 20, that's elevated. That means more risk, more volatility in the market. So you should be cautious. You don't want to be on the wrong side of the trade. And the other thing that not a lot of people pay attention to is a skew. A skew is reading 132. So for those of you who are not in the chat room and haven't heard skew is a reading that basically measures the skewness of the options on S&P 500. The reading is somewhere from 100 to 150. If a skew is close to 150, that means there's a lot of puts being bought at kind of further out of the money for downside protection. Kind of like for your black swan events. A lot of people think that this is a bearish sign. So the higher the skew, the more bearish the market is. But it's actually the opposite. If the skew is high, that means a lot of people are buying puts for a black swan event. So they think in the short term the market is going to go up. But if the skew reading is closer to 100, that means more and more people are buying at the money puts, meaning they think in the short term the market is going to go down. So a reading of 132 is actually quite low, which still kind of signal a lot of fear in the market, a lot of at the money put being bought out. So definitely you want to be careful on that. With that being said, why do we care so much about wicks, especially as option trader? It's because of this diagram that I usually talk about. Let me see, yeah. So anytime VIX is lower than 15, which we haven't seen in a really long time, this is when usually market is in an uptrend. Volatility is down, market is trending. This is a perfect scenario for your debit call strategy. On the other hand, when the VIX is somewhere around 15 to 20, this is when you want to do your condors, your short strangles, because probably market is trading in a range and you kind of want to sell calls, sell puts, sell calls, sell put, and take advantage of it. When the market is around 20 to 25, when the VIX is around 20-25, which we're actually here in this stage, this is a perfect scenario for credit spreads. So implied volatility is elevated. You want to sell premium, but you want to make sure that you're guessing the direction right. So, I talk about this. This is usually early panic mode, perfect environment for credit spreads. And then, of course, anytime the wicks is higher than 25, this is your panic mode. So you want to be really careful. Make sure you're fully hedged. We saw wicks of 30, 35 during the pandemic, during wars, like really unusual scenarios. So with that being said, like looking at the volatility profile of the market, I'm going to talk to you about the trades I'm setting up for next week and kind of my reasoning on why I think they could work out. So I have a lot of bullish strategies going into next week. I kind of feel like we saw at least a recent bottom for now, maybe until March 28 when the Fed has meeting. For a lot of the tech stocks, I think we kind of bottom at tech, and my strategies kind of showcase that as well. So I set up a bullish put spread, 585, 540, a little bit of a wide angle, but sold 585 puts, bought the 540 puts as a protection, a bullish put spread. So the direction here is bullish. My reasoning is the stock just had an earning. It seems like the bottom is in, and looking at implied volatility, we can see the implied volatility is elevated. So you definitely want to take advantage of it by selling some premium. So, credit right here. Same thing with Netflix. Netflix gapped down about 25% after earnings. It was definitely brutal, but it seems like now the bottom is in, especially after the sell-off we saw on Wednesday. We're recording this on Friday, so it's 2 days after Russia invaded Ukraine. mRNA, again, it's a healthcare sector, kind of the same scenario. My direction is bullish. I'm putting a bullish put spread right here. These two are for March 11, the expiry. This is for expiry next Friday. For all of these trades, if we reach the 50% decay, that's my profit target. I'm gonna start selling them. So that's something to note as well. I set up a condor, so a neutral strategy for Tesla. This is solely based on a technical setup. I think Tesla is trading in a range now, trading in a channel. I think the bottom is in. I'm kind of betting that all the way till next week, Tesla is going to be somewhere from 710 to 890. Nothing more, nothing less. I set this condor up as 2 spreads, so I'm willing to kind of leg in and leg out of this strategy. And a bullish ratio spread on Apple, a straddle on SPY. And the reasoning for this straddle on SPY is I believe we're gonna breach expected move again next week. We know that it's going to be a volatile week next week. There's a lot of uncertainties. So every time, if they realize volatility is going to be higher than implied volatility, what the option market think is going to happen, you're gonna see your straddles making money. So this is kind of a hedge, as well as betting that the realized volatility in the market is going to be higher than implied volatility. And I'm also building some positions through leaps. These are the 2024 $5 calls, deep in the money leaps on Robinhood. And this is more of a fundamental reason. I think the stock is getting really cheap, and it can become a really good target for bigger companies as a merger arbitrage. It's something I explain in our courses in our education center, but I also talk about it extensively in our chat room. So if you're a member, I'll see you in the chat room. If you're not, definitely feel free to check out our chat room maybe for a test drive for a week. Going back to weeklies again, make sure you're really careful when you're looking at a 1 week sector performance. You're seeing pretty much a really good performance out of healthcare, real estate, utilities, over 1 week. Definitely these are more of your defensive names. Healthcare, utilities, consumer staple, these are more of a defensive names. You can still see that we're not fully risk on yet, and we're not fully risk off yet. So it's not a risk off environment, meaning sell everything, stay in cash, but we're not fully risk on either. So yeah, definitely be more cautious. When you see a strength in healthcare, when you see a strength in utilities, the staples, that means people are being more cautious. There's more money going into defensive stocks. So definitely don't try to maybe over levered yourself, buy a lot of leveraged product. Still be cautious. I think still this market is going to be very tricky over the next few weeks, especially till we get some result from Fed. But on higher level, I think this is what's going on. You saw my trades for next week. If you're a member in our chat room, definitely come and check it out. We can have a conversation. And yeah, that's pretty much it. The tool that I'm using right now, if you're interested, you can actually check it out. It's free for everyone. It's called tradingterminal.com. You get an overview of the market, of what's happening in the market. You get the earning calendars, the charting of the stocks. So as an example, going into, let me clean this out really quickly. Going into next week, we can see we have really important earnings coming up. So let me actually go ahead and kind of tell you what earnings would be really interesting. So if you're option trader like myself, I think Zoom is probably going to breach its expected move. I think Salesforce, ticker CRM, could be really interesting. The stock is really beaten down. Snowflakes, one of the few first earnings. Usually surprises happens when there's not enough data for companies, not a lot of historical data. So Snow will definitely be interesting. Lots of action going into next week. Costco, another consumer staple name, Best Buys, lots of action. So will be really interesting to go. And of course, if you have any questions, feel free to email me or just leave a comment in this YouTube in this YouTube video, and I try to get back to you. And also let us know if you like this format. We're really excited about the station that we set up in our Bear Bull Traders office. We're going to create more and more content, more educational, more trading content, and we're really excited. With that being said, like, subscribe, and we'll see you next week.